All right, we're live. We're checking the systems. I'll get the thumbs up from Jesse here in a second, making sure that we're good across sandhillmarkets.com, our YouTube as well, LinkedIn and Twitter. So thanks to our friends at Restream that make this actually reasonably easy. And we're having an awesome panel today. We're a little cheeky with the without AI in your name. It's like semi-applicable. But I think that there'll be some good discussion about, Series B, what actually tactically, happens and gets done in these businesses. So for founders and investors who we have a wide range of audience at Sandhill, but I think typically skews a little bit earlier stage, pre-seed, seed, Series A. Maybe obviously the world gets a little thinner as it gets in the later stage. But really interested and excited to compare and contrast that against what we actually the session we had just last week or the week before with Julian and Andrew about pre-seed and seed raises. So excited to kind of continue on that theme as I kill time here. But before I do that, and before we get into it, you know me in Sandhill. If you've had this sent to you or you're tuning in from one of the social platforms, we host a lot of these. We usually do about one of these a week, usually in partnership with Sacra.com, who I'll plug in a second as well. There's a Luma that has, the schedule for the summer. We have a newsletter that's becoming less and less daily and more weekly as time goes on, and we try to focus in on what's actually differentiated there. And we have a syndicate that's typically focused on the bookends, right? The really early stage and then the really late stage stuff. Much more importantly, our guests, and these are we were talking a little bit before, but some good overlap with them that they'll let them share. It's funny, there always ends up being some kind of shared connections on these panels, which is not by design. It happens by luck every time, which is funny. But without further ado, our first guest, Michelle, co-founder and CEO Anrok, helps SaaS companies solve sales tax compliance. I'll let her do a better explanation of herself and of Anrok. But they just this year raised a $30 million Series B, and it was led by Khosla. There's again some Khosla connection that you'll see. And then before Anrok, Michelle was at Airtable. We've had other Airtable people on before again, so there's another small world at the moment. And then before that, she was at Index. So I think she'll be able to give good context from both those experiences. And then the man of the hour, Howard, who just announced the Series C today. Six out. The Bloomberg post went out 6 hours ago. So we're catching him in a hot news cycle. Excited to get his thoughts not only on the Series C but on the Series B and kind of what his process has been like in the late stage fundraising, or depending on what your perspective is on late stage. I'm realizing more and more. But Howard, CEO at Cyberhaven, helps cybersecurity teams detect instances of data exposure in real time. So without further ado, I killed some time. We've got a bunch of people here live and excited to jump into it. Howard, Michelle, thanks for jumping on. How's it going? You were telling, Michelle was joking before. So Michelle, Howard is a customer, Cyberhaven is a customer of Anrok. Both have Khosla involved in the cap table in a serious way. Lots of overlap. It's funny.
That's right. What makes this extra special for me is that I think it was almost 3 years ago now that Howard and I hopped on a Zoom. I think it was this identical phone booth, but in our old office, where I sold Howard on Anrok. And it's not every day now that him and I are in procurement sales conversations. Just shows you how far both businesses have come.
Yeah, Michelle, it kind of reminds me, we need to turn the tables, and you need to be the buyer and I need to be the seller. So maybe we could do that at the end of it.
Yeah, this is good. I'm glad. We won't do that. We won't do the pitch on the stream, but we'll count that as an intro from our side. And well, awesome. And I think that I gave some really light intros in terms of who you all are and what you've been up to, not just obviously in the business that you lead today, but before. Would love to get more thorough kind of introductions. One of the businesses that you lead now, Anrok and Cyberhaven, and then personal backgrounds. I think would be super helpful context for everybody. Howard, would you be game to lead us off?
Sure. Yeah, I've spent most of my career in product or go-to-market roles. I started in cybersecurity in 2000, so I've been around cybersecurity for most of my career, the past 24 years. I spent some time in data infrastructure companies as well. Probably my best two companies in terms of my success and contributions were Palo Alto Networks. I was a very early employee there and part of the marketing team, and helped scale that company all the way from initial sales to $1 billion in run rate, and in a very successful IPO. I will tell you, Palo Alto is probably going to be the most efficient and capital efficient company that I'll ever be part of. They raised roughly 70 million, 70 lifetime, and it created a $100 billion company. I don't think we're going to see too many of those anymore in this day and age. Sure. And then I was also a very early employee at a company named Nutanix, which is also now public, and I was the CMO there, and had a lot of great fun during those journeys. Met a lot of great people, learned a lot, and set me up to be a CEO here at Cyberhaven.
Awesome. And Michelle, yeah, you game to match?
Background, so I'll start in the beginning, like how I did background more on the engineering side. So academia was all engineering, ended up focusing on my career in finance, was in venture capital, investing in early stage software companies, mostly enterprise software, infrastructure, and AI at a firm called Index Ventures. I ended up coming across the sales tax problem a few years later. My initial instinct was to find a startup to invest in. You can take the goal out of VC, you can't take the investor out of the goal. So I ended up looking for spaces to invest in within tax. Couldn't find a company doing this well. So I ended up starting Anrok about 4 years ago. And we help software companies with sales tax, specifically US sales tax and global VAT, GST worldwide.
Very cool. And I got a little sense of timeline in both. You were selling Anrok to Howard 3 years ago. You started 4 years ago. Howard, I think there's a little bit of longer timeline on Cyberhaven, on the Cyberhaven side. Would love to hear kind of, again, before we get into the more tactical kind of Series B, Series C, what does fundraising look like pre, where we are today? When you look back on the fundraising story of the business, can you share kind of some of the highlight milestones and timelines that are relevant to continue to kind of contextualize, what we're talking about today?
What's interesting about our story, the lifetime of our funding events, is we missed all the froth. And the reason for that is because, and some of this predates my time. I've been in the business 4 years. I joined exactly 4 years ago this month. But before my time, so I joined in 2020 in the early days of the pandemic. But before that, when, and into the first couple of years, we weren't fundraising, or we had raised suboptimally, I would say. The business was looking for product market fit and probably didn't have the right team. And so we were not one of those super hot unicorny type companies that attracted just crazy valuations and are having a hard time sustaining in this climate. So in some ways that was really good, but in a lot of ways it was perfect for me, because I grew up, I mentioned the very capital efficient business I was part of. I started my career right after the .com bubble, and I got kind of well versed and grounded in being scrappy and building startups the right way and being extremely capital efficient. So I'm not sure I would have been real good at raising huge rounds and spending crazy amounts and having like a 5x burn multiple. But it's worked out really well for us. So we raised the founders raised the Series A in late 2019. And this was really coming off a product pivot. We actually started on a different idea and then pivoted to the current product idea in 2018. And so we had some initial product at that point. So we raised the Series A. The Series A investor had an agreement with the founders. They were going to bring a new CEO. So that's when I came on board. I ran the business for about 18 months, and then we raised the Series B in December of 2021. So you can imagine, a lot of that froth was starting to dissipate by then. And so we had a very solid round. Redpoint led it, great investor, had a very reasonable valuation. And then we just raised the Series C, closed it 5-6 weeks ago. So we missed a lot of the froth. I mean, I think that's the short summary for our funding history.
Yeah, that's and depending, it's funny when you look at it that way. Like I'm sure it was a little bit more painful in the fundraising process, and we can get into that, but probably ends up being for the best. The froth is double-edged sword, kind of in terms of easy money. Definitely makes just being capital efficient harder.
Yeah, in a lot of ways. I just to give one more comment on that. I do feel like we've always been kind of behind the curve a little bit, always like, not struggling, but always very focused on getting to that next milestone and doing everything possible to raise that next round, and feeling like we were underinvested in certain aspects of the business because we didn't have all the capital on the balance sheet. That changes a lot with the current round that we just raised. But up until this point, 4 years now in the business, I've always felt like my biggest constraint to growth is capital, which is crazy to say, given we've come from these last few years. But again, built really good habits inside the company, really helped shape the values of the business, and it just aligned to how I operate. So it's been good.
Awesome. Yeah, Michelle, can you get, and it's funny, the 4-year mark. So you've both been kind of in the chair for similar amounts of time. Michelle, can you give a similar kind of backstory on the pre-Series B? And the Series B was just in April, right? So pretty fresh off of that as well.
That's right. It was earlier this year, and similar to how there's many weeks between getting the term sheet, closing, and announcing. So it was a few months ago, but similar market dynamic where I think neither of us are canonical AI companies, and very few other non-AI companies are raising in this market. And so it was interesting for us to feel out the market and figure out, is now actually a good time to raise? So we can get into that in a minute. But the pre-Series B story, both our seed and A rounds were co-led by Sequoia Capital and Index Ventures. One benefit of having a co-lead at the seed is to avoid signaling risk. When you're raising from top-tier investors that are typically institutionals that like to lead Series A's, there is always some risk that they won't follow on and lead the A, and there is some negative signal to the market. There are always data points that show signaling risk isn't real. I do think people will anecdotally feel that no matter what. And for the CEO and the founder, you will feel pressure. And so one thing that I'm really grateful for is we had 2 amazing partners co-lead the seed. And so that meant when it came to our A round, we actually did not talk to any external investors. And it was our internal investors preempting the round, ended up making space for the other investor and really continuing that partnership along. And for us, I think that worked really well. We liked who we raised from. We knew the investors, given I had been in VC. And I would recommend that if you are considering raising from an institutional at a seed, make sure you're leaving room for other players that could come in and lead the A.
Yeah, makes a lot of sense. And you both kind of mentioned it. There's a lot of kind of craziness around. Parts of the market are definitely frothy. I think it's maybe a good, before we actually get into the Series B stuff, good reminder of what maybe the Series B is. I think to people, I think obviously it's after A, it's before C, but in terms of what it typically looks like, I think there's a really, really broad range of, the headlines that people see. When you think of, and when you both inside your business and outside more generally, when you think of Series B, what are some themes, right? And maybe metrics that, and hurdles, what are some of the broad strokes of what you think defines a Series B company? Right? And outside again of the $1 billion Series B raise on a $50 billion whatever, from the AI world. I think it helps people to be reminded of what a more, I don't know if traditional is the right word, but a not AI Series B, let's call it.
I can go first. So
Yeah.
I think pre-Series B, a lot of the fundraising story is based on logos and the story you can paint around custom attraction. I do think at the B, the narrative is starting to be painted around metrics. And every business is different, but typically having 2 to 3 key metrics that paint the picture for the business. So typically having one revenue-based metric, it could be a year-over-year revenue growth, for example. And then I would recommend having 1, maybe even 2 efficiency-based metrics given the market today. So this could be net dollar retention, it could be CAC payback, it could be a burn multiple. And just taking those 2 to 3 metrics and really painting your Series B story around those metrics. Howard, I don't know if you had a different experience given you are later stage.
I agree with all that. I'll reflect back on my Series B raise. here first, but I agree with all that. I think in addition to that, a lot of Series B investors are looking at different paths to exits, right? Because once you get later and later, the window to successful exits shrinks. At Series B, there's still a very viable path to be acquired. So I think one of the things that is really important is demonstrating differentiation, and you do that through win rates, your pipeline or POC win rates. I think that's another very important metric for Series B investors, because they want to seek unique value and differentiation in your tech, some sort of defensible mode, and to see that, okay, this is an asset that even if the go-to-market doesn't perform for whatever reason, or they can't scale it, that there's a very good path to an exit through an acquisition. And so I think painting that picture of where you fit competitively in the market is really critical. In addition to showing a very high win rate. So I could just tell you, like, I think roughly 70 to 80% win rate in your POCs would be deemed very good at that stage. And if you have that along with the growth and efficiency that Michelle talked about, I think you're going to be set up well.
In terms of like the broad range stuff, in terms of amount raised, and then in Series B there is a wide range. There continues to be, but outside of your own businesses, thinking like at a high level, is there like a cookie cutter Series B that you can think of from an amount raised, from a valuation, from just again broad strokes outside of your businesses that you think can ground people a little bit? Because I think again it can get kind of crazy. Like, so you mentioned, 70 to 80% that's a very like interesting and like tactical metric for people. But when you think about growth, when you think about run rates, are there broad strokes that you can paint for us in terms of where you think that typical Series B company might live?
Yeah, for me, I would say somewhere between 20 to 50 million raised. I think growth rate that's close to tripling, somewhere between 100 to 200% growth rate on top line ARR. Efficiency, I think you're still going to be probably above 2 burn multiple, probably, because you're investing a lot in growth of the business. So probably like 2 to 3, 3.5 burn multiple. There are a lot of benchmarks on this that are out there, but this is kind of like my framing of what I think is a normal Series B.
Yeah.
And then the final thing is probably how you are attacking the market and distributing all that capital. I think that's a really important thing to look at too. Like, what are you going to do with the funds? Is it just to scale the sales and marketing machine, or is it also to really continue to invest in building out the product to prepare you for the next series?
Yeah.
And +1 to everything Howard said, the one thing that I would flag is that you want the market to really set the valuation. You might want to know where you might land.
Mm-hmm.
But the main thing to have a perspective on is the amount raised. And the thing that I find helpful is to have like 1 or 2 lines around how much you want to raise, and repeat that throughout the process, because investors will triangulate on, okay, Anrok needs to or wants to raise X amount to meet Y milestone. And so that when you get into the negotiation point, they're not trying to tell you to raise more, and you might dilute yourself more than you'd like to, or they might be trying to tell you to raise less so they can fit themselves into the fund structure. And if you make it clear early on and you repeat the same thing over and over again, this is like how much I want to raise and this is what's best for the business, that can help you toe the line of getting the round size you'd like. And the other thing to remember is that round size sometimes gives an indication on what valuation you'd like.
Yeah.
Not always exactly. It depends on the sector and the business. But typically, the investor hears the valuation amount. The fundraising amount.
Yeah.
They know what ownership targets they're going to hit, and so that's how they're going to be thinking about valuation.
Yeah. Sure. I'd love to ask you one follow-up question, because I love this topic. When you're signaling the amount, I'm curious, do you signal a little bit below where you really like to end up, a little bit above, or right at where you want to end up?
Our future selves might hate us for disclosing the secret for future raises, but I do think signaling a little bit lower, not by too much. You know that you need that, just so that you have room to move up if you need to. That's my philosophy.
Yeah, 100% agree.
Yeah, that makes a lot of sense. Where the kind of the minimum that you need to get done the things that you want to get done, leaving room for expansion and for economics on the other side of the table.
And the key, and I think the assumption I'm making in this is that you have ample runway to like walk away. And when I think about going into a fundraise, it's not saying, hey, I want to raise, in X month or X quarter. It's more like I can raise in the next 12 months and my business is just starting to hit the metrics for the next milestone. And I have this window where I have enough runway and I can avoid big troughs in the market, and I can minimize or skip a quarter if the quarter comes in and we missed our target, and I can wait one more quarter. So giving yourself that buffer. If I take a big step back, there are really three variables. One is business performance into a fundraise. One is your runway. And then the third final variable is the market conditions. The only thing you can really control is how much runway. Right? You can kind of forecast, you can kind of control business outcomes. You can't control the market. And so really thinking about fundraising as a window of like 12 months rather than a finite point in time can really help you time when is best for the business to really lean into those conversations.
Yeah, that makes a lot of sense. And I think it's a great segue kind of into within the Series B. And we never toe the line between Howard. I don't need you to, talk all about your Series B when you just, have this big Series C. So when there's room to contrast the two, or there's any learnings kind of from B to C, and please jump in with it. But I think we talked a little bit about, metrics. Talk a little bit about timing, Michelle, on the, that 12 months. And then I can picture it like you're looking at, Q1 or the Q1 of this period, and seeing if you can check all three of those boxes. If you check all three of those boxes, it's time to go. If you only have two of the three, maybe wait another quarter to see if you're able to, again, check all three of the boxes on runway, business performance, and or I guess runway's always checked in this period, hopefully. But or I guess, Howard, to you, does that line up for you on the timing side of things of how you think about the raise before I move on to the next one?
I think I agree 100% if you really do control the runway. like I mentioned earlier, I'm sure a lot of people in the audience can empathize. It's like sometimes you play the hand that you're dealt, and you don't have as much runway as you'd like, and you do the best you can. In our case, I alluded to this earlier. We were always a little bit behind the curve in terms of where we were in terms of our metrics, and then how much runway we had and when we needed to raise. So I was more forced into my timing than I probably would like to have been. But I agree with Michelle. If I could just decide at any moment when to raise, I would like to start 12 months before I really need it.
Yeah. One thing that came up in that kind of prep doc that we had put together is team, and in how you think about your team kind of pre-raise, and if there are certain. And I hadn't really thought about it this way, because I've definitely always been in the mindset of what Michelle was talking about, of runway and your metrics and ultimately market conditions, where obviously team filters into runway, filters into business performance. But are there kind of key roles that you thought about before the raise that were or after, or something that you're raising for that would be relevant? Is there a certain team, or you need a certain type of person, and this is different from each business, but that you thought about before you go out for your Series B, you want this key hire on the deck or in the business? Is that something that was relevant to it, or is that more of a use of funds? Like, once we get the money, then we'll go out and hire this X key person.
I'll go first, Michelle. I think in my case, I think we had someone on the go-to-market side that has scaled businesses in the CEO. And so there wasn't a lot of deep due diligence on the team. I think if you are in a situation where you're a technical founder and you're raising a B or a C, they're going to be looking for someone on the go-to-market side with that experience and that network, and someone that could really architect the business. So I think that's going to be a pretty key role. When you get the B or the C, you're assuming there's good product and technology people there. So I think the key hire for the B stage is going to be someone on the go-to-market side. And I think that could be both a sales leader or a marketing leader, because I think some of these businesses are probably going to be more marketing driven, more PLG. Others are going to be more sales led. So it depends on the business. But one of those two roles, I think they're going to be looking for someone with a lot of proven success.
Yeah. I think besides the cases where you need that business counterpart to the technical founder. There are cases where I think that hiring ahead of the fundraise or timing it to a fundraise is important. I would more think about hiring for the good long-term needs of the business. And so I think about team hiring less linked to a fundraise. Obviously, after a fundraise, you'll be hiring more, but I try to separate the two from each other.
Yeah, no, that makes sense. Well, you're not gonna make a hire for the Series B, but having maybe the right people in place to scale, which is ultimately what Series B investors are looking at, is very relevant. Makes a lot of sense. And one of the kind of the next thing that I had on my list as we move through this is, so you talked about kind of that 12-month period where, and again, Howard, right? Like there's the ideal and then there's the reality that kind of happens within, any fundraising story. When you think about prep, and you think about, and we mentioned, I think one of you mentioned this, I think Howard, you mentioned it before, when you're thinking about, putting your list together. And I think a lot of early stage founders will, your target list together. A lot of early stage, this is relevant across stages. Like, who do you want to have as investors? Like, how are you thinking about, your partnerships and, who's going to come into the round? What does prep look like around a round? Like, so you say, or you have it, going ahead, obviously target list is one, but I'm sure there's other stuff. Obviously there's materials, data. You mentioned kind of actually what the business is doing, but then there's taking that data from the business and telling the story with it. How, what can you share with me in terms of, how long it takes, key materials that you obviously, we're coming back to time and time again, and maybe any surprising places where a lot of time gets spent that maybe people wouldn't normally think of, or especially if you're, the early stage founder compared to, a later stage founder such as yourself.
One thing I would recommend is to grab coffee with investors twice a year and set aside distinct periods of time to do this. I know some founders say, hey, don't talk to investors at all before a fundraising situation. I do think that is a lot of pressure in the fundraise to get to know a long-term partner. And so my recommendation is to really time box. You'll probably get a lot of inbound. Don't reply right away, but really say, hey, I'll grab coffee, in X month, and try to time a few of them around the same time. What that allows you to do is to really stay focused on the business most of the time. Come in prepared with how your business is doing. You might not want to share that many metrics, but at least you can speak to a place of confidence and paint the broad strokes. And then lastly, you can get a good pulse on the market because you'll start seeing patterns from one investor to another of things they're interested in, the types of questions they ask. So even if you're not fundraising, those coffee chats can be helpful. Now, those coffee chats might turn into a preemptive raise and folks lean in saying, hey, would like to preempt your next round. While that worked out for us, I would recommend the best thing is usually to run a process. You get to speak to as many investors as possible. You'll have the data room ready in advance. You can have the time to line up your ducks in a row. So that's one thing to keep in mind if you do go with a coffee strategy and set aside time. Be really clear on when you actually want to lean into a fundraise because it's very easy to get pulled into something that you're not ready for. Howard, I'm curious how you did it.
Yeah, I think back to the question, I would say there are probably three sets of things that you want to prepare. Obviously, the deck and the story, the financial package, all the metrics, projections, all that. And then the final one is less quantitative, more qualitative, which is preparing your references. I think that's also equally important. Sometimes, the investors are doing the references even before engaging with you. They're doing their own checks in the market. But I think making sure that your best customers know that you're about to start fundraising, they may get calls, I think was also another part of the prep that I try to do. So on those first two pieces, I think what I would say, I was surprised by how little time people spend and how more time than I expected people spend in certain areas. I was surprised that investors spend less time on the projections because essentially they just want to know okay, how fast do you think you can grow? And then they're going to model their own assumptions, right? So they dug a lot into sales productivity metrics, I would say, especially at the last round, the Series C, because I think at the B round you've probably only got maybe 5 to 10 sellers. Many of them were ramping, so there's not a lot of data. But when you get to a C round, you probably got 10, 15 sellers, and there's a much larger set of cohorts there, and they want to see that you can consistently get reps hired and productive and successful quickly, because that's going to be a key part of where your investment dollars are going. You want to make sure that those dollars are going to yield good results. So I think there was a very, very intense focus on sales productivity in my last round, and less so at the B. But certainly, like, all of that sales productivity and efficiency data are going to need to be in the package.
That makes a lot of sense, and I have a good friend who does sales hiring for a company. I don't know if you've either of you have met a guy named Ian Feeney from the Canon Project. Works with a lot of like Series A, Series B, and whatever he talked a lot, and it's his whole world of the sales productivity, like people hitting their metrics, and ultimately that filtering into these rounds, because like you said, like the efficiency there is such like a health metric for the business. One of the things that came up earlier, and that this word of kind of efficiency comes to mind around again, is like, capital efficiency, and how you're thinking about, one, dilution, but two, trying to give yourself some wiggle room, right? I think you can be overly optimistic about how efficient you're going to be with your capital, and then underraise. There's a lot of people that err on the side of overraising, seems to be the more typical, at least in the AI space again that we've been talking about. How did either of you and both of you think about capital efficiency and being realistic, I guess, with how much capital? Because you're modeling out, like, I'm going to, these numbers are going to, this amount raised is going to get me to this point, but that's built on a lot of assumptions, right? And that's built on a lot of you and the leaders within your company making decisions about how much you think you could need, but then obviously leaving wiggle room. How close, how aggressive do you think it's important to play it? Do you err on the side of being really conservative? And tell me a little bit about how you think about capital efficiency, and ultimately that's going to build into the how much you want to raise number.
I like how Howard and I think are on two sides of the spectrum, is my guess, given Howard's comment on, hey, we're usually behind where we need to raise. We're like focusing on the business and not focusing on fundraising. Whereas I think for us, our last few rounds were preempted. And so for me, when I think about the amount raised, I was thinking about keeping it low as possible, because we had a lot of runway ahead and we didn't need to raise. And so from us, it's thinking through how much faster do we want to grow? And how much does a significant new partner need in order to make this work? So for me, it's been more about how fast we can win the market and what we need to do that, knowing that we still have several years of runway in the bank, and balancing between like over raising and trying not to be too greedy and trying to like push runway to the very last minute. So we've had a big safety net every time.
I think a lot has to do with your ambition, honestly. How big a business do you think you could really build, and how realistic is that, given the market dynamics and the incumbents in the market, and how unique your tech is in the market. For us, we've always had the huge ambition. We think we can build a massive company that's the data security platform for the enterprise. And so for me, given that long-term ambition, I think it always makes sense to raise more than we really need to get to the next scale. And our round is substantially upsized from where I started. When I set out to raise, we were at a fraction of this number that we just announced today. And so it speaks again to the ambition, because I know with this capital, we're going to pour a lot of that into product, into building out the product, and continue to maintain a very high investment in R&D. And that's going to help us engineer a good outcome in the long run. Because the more you start really overly focusing on efficiency, the more you're engineering a mediocre outcome, I think, because you're not investing in the product. You're really only focused on the areas where you can get immediate efficiency, and you're maybe not going to the U.S. federal government, for example, where it takes a lot of investment, long sales cycles, but huge business in the long run. You're engineering yourself to go capture the immediate opportunity and not really optimizing for the long term. So I think more capital, more money on the balance sheet enables you to go focus on the long term.
There's a good quote from Khosla, actually, where he was getting interviewed by someone about rounds, and he said that profitability is admitting a lack of growth opportunities. That and it strikes you. It's comes off, and I think that the market has swung drastically, right? In between, like, who cares about profitability? Pump it up. It has nothing to do with anything. To all of a sudden, everyone wants to see profitable businesses, and then this. I think obviously it's kind of, I think, even keeled out back to like, it is venture. It is a growth business. It's not a dividend business. Not distributing capital to people. But the Khosla quote was still like semi-viral, at least within like the venture ecosystem, as like, that's kind of a crazy thing to say. Like, it's admitting, it's almost like a guilty plea of like, we're profitable, but we don't have anything else to spend the money on. How do you think about that? How do you think about profitability, obviously maintaining the business, and then the ambition part of it? Do you have any gut reactions to that quote?
It's funny. The shared investor that we have from Khosla Ventures is Ethan Choi. And one conversation that I had with him after the investment was thinking through our customer acquisition cost. And traditionally, it's been very low for us. And as Howard mentioned, if you're an ambitious company, you want to win both the SMBs, mid-markets, as well as the enterprise. And all of those have different CACs. And so something that Ethan encouraged me to think about is like, we should be so much more comfortable with much higher CACs than you have. And it's all about measuring it, being able to segment the different, SMB, mid-market, enterprise, and get a sense of, okay, we're acceptable with this CAC for enterprise, and for SMBs, let's try to keep it efficient, and just making us think through those motions and be willing to actually go up on our spend. Howard, I'm curious what conversations you've had.
Yeah, a lot of similar conversations. I think Ethan is very aligned to our ambition to build a massive business, and thinks there's a huge opportunity here for us. So we are investing a lot, and he's encouraging me to invest more aggressively because I think there's a really timing element to it as well. Just that there is, I don't want to call it a land grab, but there is a lot of activity in our market right now, from big incumbents. Lots of startups being funded. So to be overly efficient right now, I think we would engineer suboptimal outcomes. So we are definitely investing aggressively. I think to your question, Adam, I feel like there are ways that you can kind of pick it apart. Like, you look at your gross margin profile, obviously, and see kind of like where that is relative to where you think you could get it. That's one layer of efficiency. The other layer is obviously your sales and marketing efficiency with things like magic number. You even can go a click lower. Like, what's the efficiency of my marketing team producing pipeline with the dollars that they get in program spend? So there's all kinds of different ways to slice this. I think, like, when you kind of pick it all apart, it just has to tell the story that is consistent with how you're managing the business. And for us, it's always been, look, we're going to be a little less efficient on product gross margins right now, because we're trying to make sure our customers have a great experience, and we don't want to, be too cheap with our cloud infrastructure spend. We want to over provision their environments. We're going to bring a lot of AI capabilities in, and we're going to have, some drag on gross margins from that. So, but long term, here's where we could get it, and here's how. And our sales and marketing is going to be very efficient. Here's our, magic number profile, where it's going. And all of the kind of excess spending or investment we want to put towards product, because we're building a platform company, and we think we could ship lots of products every year, new products every year. So I think that story really resonated with our investors.
Yeah, interesting. And just for me to regurgitate to see if I'm understanding, like, control more so than like being able to control that, like making a conscious decision to be less efficient is different than just being less efficient. Is that, yeah, like control over the levers and being thoughtful about the spend is very different from just spending. I feel like that's where it gets kind of lumped together, where there's different types of profitability versus the decision to not be profitable versus the ability to be, if you were to choose to go that route, but you're making a conscious decision not to, because of the opportunity that is down the, the heavy investment route.
It's that intentionality point that you're talking about, but it's also like picking it apart, because when you blend it all up into one metric, like, BRRRR multiple is a very common metric that investors use. It blends all this stuff together, and so it really, you really have to go to the next level, I think is what I'm saying, and make sure that those next level metrics really support the story that you're telling.
Yeah, got it. Makes sense. And so you both mentioned Ethan, and I know that there's relationships at Khosla, there's relationships at other firms like Michelle from her days at Index, and obviously Sequoia in the early rounds, and Howard from early rounds, I'm sure. I had an interesting conversation with a late stage investor, a guy named Arnav from YC, who's still kind of deploying and working on the late stage side there. And they take a very founder focused approach. And they can, even in the later stages, we talked a lot about data, but the word ambition has come up a few times. And it's something that Arnav really kind of hammered home with me, of investing in people, and leaders who have ambitions of building a really big business, and of the bet there. And I think it kind of intertwines with the question ultimately that I'm asking about the partner relationship and the people that you work with on the other side of the table, and how much, one, you're evaluating them, and how much you felt them evaluating you personally outside of the numbers, right? Obviously you're standing next to the numbers explaining your business, but again, that's what Arnav really kind of hit that home with me, which is very common in the seed stage, right? Like that's the whole kind of game in the seed stage is, we're betting on founders, what do the numbers really mean? Whereas late stage, there's lots of data. And I think that maybe I would love, to hear you both talk about the personal relationships there and how much you felt yourself personally being evaluated next to the numbers and obviously the ambition you both have for building big businesses is apparent. But I think that I was just surprised to hear how much that continues to drive decisions as the checks get bigger, as the businesses get bigger, as the data, the data room gets bigger, but that's still, a founder ultimately that has to lead it in that direction, decide not to sell, all those different things. How were those conversations?
I can go first on this. I'll tell you, I think it's the long-term ambition everybody wants, but I think investors also, especially at the later stages, B and C, they want more accurate forecasting and plan setting. And I think sometimes those two things can come, and there's a tension there. There's some conflict. I've probably been guilty of setting really, really aggressive plans, and I just think that's the right way to build businesses. You set a very aggressive plan, you come up to 90%, 95%. I think that's a great year. Rather than setting a very conservative plan, you beat it by 20%. I'm just more in the former camp. And I think some of the investors that did due diligence on me as a leader of the business, this was one of the top things that they wanted to drill in on. They were like, man, Howard is so ambitious, but is he forecasting well? Is he managing the business well? And I think sometimes, founders can kind of give off that impression that they're so overly ambitious, so focused on the long term that they're not managing the numbers well, day to day, quarter to quarter. So I know this came up for me, but it's finding that balance. I think it's like having that long-term ambition, but also showing that you're setting and beating your plans consistently, but also setting the plans fairly aggressively and not just, setting layups for your team.
You are definitely being assessed in a fundraising process, I think. And it goes two ways. I think for me, when I'm looking at Khosla Ventures, when I'm looking at Ethan, it's that partnership. It's the combination of the firm and the partner. Both are really important. To me, with Khosla Ventures, I think they're a firm that has traditionally done very, very well, and they're only doing better. I think if you look at the bets they've made in the last few years, it's been really cutting edge, really innovative, and they're really breaking out from the pack. And then with Ethan, every time I met with him, I felt like I learned something new. Ethan actually used to be at another fund. And so when we'd grab the coffees twice a year and catch up, he was definitely one of the top folks that I was planning to lean in with when we were doing our fundraise. And timing wise, he had ended up just joining Khosla. And so for me, it was that combination of this is a partner that I've known for a while, I'm very excited about, and this is a firm that is doing very well. So I was excited to go with them on that front.
And that leads to, and that's great. And it sounds like, obviously you both had great experience with Ethan specifically, which is funny, small world. But there's definitely a decision. You mentioned it earlier, Michelle, about and you didn't actually have this experience, but maybe Howard could speak to it. And I'm sure that you've been on the other side of the table with founders that we're running full processes, right? That ultimately, we're in the market, we're taking in basically as many term sheets as they could get their hands on before ultimately making the decision. You mentioned, combination of partner and firm. I'm sure, valuation comes in there as well. But I'd love to hear a little bit about how you're making those choices. Like, how are you evaluating the other, and you mentioned a little bit about that specific relationship, but how you're thinking about that partnership and balancing firm partner valuation and maybe other variables that I'm not aware of.
I'll probably say the something I probably shouldn't say, which is valuation is always going to rule, right? Like, let's be honest. I mean, I think we can also talk about the partner, the firm. Obviously, those are critical, but valuation is at least 60% of the weighting, I think, because it dictates how much you can raise and what dilution and all that, right? I think in addition to firm and partner beyond valuation, I think it's also deep pockets, ability to continue to fund the business in future rounds and maybe even do inside rounds, depending on what might transpire in the business. I think that's really important. And then the final thing I look for is, like, how much do these investors really lean into helping you? Because they may be great. This is what I do my due diligence on when I'm trying to make the final selection. Like, how much are they really leaning in, and are they overstepping at times? Are they trying to help too much in areas where you're not asking for help? Really trying to understand that, because that's where tenuous relationships will arise with your investors. So I think really understanding, like, what kind of help you want, how much help you want, what's the cadence of engagement with them, and what's their expertise to help you in those areas. Really making sure you're thinking through that intentionally, I think is important.
I think a negotiating tactic that is pretty common from investors is to say valuation doesn't matter. And I agree with Howard, like, valuation does matter. And so when someone tells you, hey, you should be picking, not only on valuation, I think it's important to remember why valuation is important at a later stage. It's things like signaling to the market of your maturity. It is, as you grow, you might want to make acquisitions, and having a larger valuation might help you from a stock-based acquisition perspective when you're acquiring other companies. I think in the earlier days, valuation, I'd say dilution matters more than valuation, right? Seed and Series A, optimize for dilution, probably valuation doesn't matter. As you grow larger, I do think valuation matters. The other thing that I would add is that only talk to partners that you actually want to partner with, right? That's the baseline. And so, to me, don't spend time with people that you don't want to be spending the next decade of your life with, and not minding that they'll be on speed dial, right? You're probably going to be texting them several times a week on different matters. So picking people that you want on that journey is another thing that I think about.
Yeah. Michelle, can I ask you one question about this? Because in my experience, you don't really know these people, right, in this kind of courtship process. So how do you quickly get to what type of person is this? Am I dealing with here? What kind of investor am I dealing with? Are you just doing a lot of back channels? Or are you kind of relying on, general industry reputation? Like, I'm curious. Or are you taking one meeting with everyone? And in that one meeting, you could assess, like, is this the right partner for me?
Yeah. So I do think those coffee chats matter a lot, where you spend an hour, 2 hours with them at least twice a year. And again, that's not a ton of data points, but that gives you a baseline on your chemistry. And hopefully you learn something about the business. And then throughout the fundraising process, you end up spending a lot more time. I think I have an unfair advantage in that I used to be in venture. And so my job was to spend time with a lot of the investors. So I think that is where a lot of my familiarity with the people I'm speaking with come from.
Yeah. I also, in addition to, I rely a lot on my current investors, like, hey, what do you think of this firm and this partner? And I kind of cheat or, get a little bit of a preview of what I'm likely to experience through my current syndicate.
It's interesting you mentioned the coffee chat aspect, because the first time that I actually experienced that directly was with Dan Soroker, who formerly Optimizely and now was Rewind, and then now it's Limitless. And he had done like a public version of this, actually. I don't know if you remember, he did like the public raise. Ultimately, NEA led the round. So I think it kind of landed how it was going to land when he did like the public version of, I think it was the Series A, but he came out for basically like a public version of Coffee Chats where he put a Calendly link up, and you could donate $100 to like as an investor to grab a time with him to meet him or whatever. And I'm interested, I have to check back on his account to see how that, I said that he priced it too low and he's going to waste his time. But I mean, our conversation was solid, at least from my point of view. And it was exactly that where, because I ended up, I'm asking, what's the round looking like? And his response was, every 6 months, I devote a week to these types of conversations. He stacks his days with a ton of investor calls, gets a sense of the market, old friends, new friends. And it felt very tactical and beneficial, where it's outside of, what you may or may not be raising, but still very productive, and not taking venture capitalist calls randomly as they pop up, which is, when you're doing well, probably pretty regularly, and something to mostly to ignore when you're outside of the cycle. The kind of last section that I had lined up for us that I'm interested is one, we'll start the other way around. When you kind of look back on, what we've been talking about, these Series B and ultimately Series C, we've each shared kind of some lessons and some insights. Anything top of mind, maybe most surprising, things that really stuck with you from the processes, fun lessons learned, kind of highlights that you can think back on that you think are anecdotally important for maybe someone at the Series A stage who's going in and maybe looking ahead, 12 months away and wants to learn from, hard lessons learned or maybe some easy lessons learned if those are possible.
Something that was helpful for us is that we had already written a memo going into 2024 for our existing investors on the vision of Anrok, where we're going this year. And we also use that internally to help rally the team around writing the closest thing to OKRs that we have. And so this memo was really helpful when telling the story to external investors. So that's number one. And then as a part of that, we also then did a 5-year, like very high level model. Startups, things change all the time. And so on the one hand, when you do this 5-year exercise, in some ways it feels like low confidence. Is it even worth my time?
Yeah.
But the thing that's useful is to then, once you look at it and think about, okay, if I want this new product line, if I want to be a multi-product company, and I want the business to be making this revenue in 4 years' time, I need to be resourcing it, like this next year. And to do that, we need like this money today. So that's a type of exercise that I think was like very helpful for us to go into the fundraise, knowing what the story is and what funds we needed.
I think one for me would be casting a wide net. I think it's hard to predict where the strongest interest is going to come from, even though you've had these coffee chats and you kind of know reputations of firms and investors. Your current syndicate is probably guiding you in some way. But in both of my rounds, there were surprises, and the Series B investor, in the meeting when I did the pitch during the process, I didn't even think that they were that engaged, and I thought, oh, there's no way, these guys probably are going to tell me that they're not interested, but they were the ones that stepped up and led, Satish and Redpoint. And at Series C, this is an investor that I spent a lot of time with, and I personally felt Fred Wang at Adam Street. I thought he was really leaning into the story, but some of my existing investors weren't sure that he would come in at the right valuation to clear. And so you get surprised, and I think it's important to cast a wide net and run an efficient process. I will say that as you get later stage, you're going to get a lot of the kind of private equity hedge fund type investors, and what you're going to get with that crowd. They're going to be over-indexed on the metrics. They're going to get hung up on 1 or 2 metrics, and it'll probably stall or kill the deal for them. So unless your metrics are like really perfect and pristine, I think most of the investors in that type of cohort probably not going to be right for you.
Yeah, interesting. Well, then as the kind of the final note, as we look ahead, as you both look ahead, right, with fresh war chests to varying degrees. What, I guess, and keep it kind of within the realm of fundraising, I guess, what's kind of the next step? What within the businesses, what are the things you're most excited about, ultimately using the capital for, as much as you're willing to share about, the kind of exciting next steps and the things that are unlocked through the capital, right? Because you don't just raise to raise, right? You raise in order to fulfill the ambitions that you and your team, need the money for. And then as a kind of the back of how much is the next round in the back of your mind at all? I guess would be the two. Like, do you just, put it on the table, it's over, and then, I'll deal with this late, I'll deal with this in a year and a half, or is it kind of always there? Those would be that's my big wrap up question.
Howard, I don't know if this happens with you, but after going through the pain of diligence, after a fundraise, even though you have a war chest, you're more stingy than ever. Yes, we need to hire, but let's be really careful where we're placing our bets. And yes, we have this ambitious goal, but we need to make sure that every hire counts, every hire matters. So for me, after a fundraise, I'm actually very neurotic about how we're allocating that investment and putting it to the most productive use cases.
100% agree. Actually, 1,000%. Because
there he goes with the overambitious estimates.
When you kind of release some of the pressure in the system, it's very natural, especially when companies are running hard. All startups are hard, right? All these journeys are hard. Your teams are grinding. They're having really hard quarters and just trying to get through and just grinding away. When you have this fresh pool of capital in, it just releases a little bit of that pressure, and I think that's healthy in some ways, but unhealthy in other ways. And I'll give you one simple example. Today, we announced our funding. I've got hundreds of inbound messages, many of them congratulatory, but many of them people that want to join now. And it's very easy to kind of fall into the, hey, this person was great at, in my prior experience working with them, and maybe they could be great here. And you start to relax a little bit of your criteria for hiring. And that's a very dangerous time. So I think just maintaining the discipline and the scrappiness, like Michelle was talking about, 100%. That's the most important thing post fundraise. But, and Adam, to your question, I am thinking about the next round. I'll be honest. There are investors that didn't quite get there in this round that I know would be great investors for us for the next round. And I know what numbers and metrics I need to prove to them. And we're not going to be that far off. And so I am thinking like, okay, what's the earliest something like that could happen preemptively? And who are that short list that I would have for preempting? So it's always there in the back.
There. Yeah. That's smart. Well, it's good. It would probably be more where like, I don't think about it. I put it down for 12 months, and then if I was listening, if I was on the team, I don't know if I'd love hearing that. Well, great. Hey, we're right on schedule here. At the hour mark, we had over 100 people here tune in live. Really appreciate everyone who did. And I think that we'll cut this up after. We'll pull out some kind of key learnings and really appreciate it. I think that the interesting part about a lot of what you all shared is that it's not that different. There's definitely some kind of key differences between early stage. It seems a little bit more pointed. I think a lot of the advice, and as it kind of progresses and as companies progress, a little bit more focused in terms of and a little bit more tactical, which I think is super helpful and ultimately can be applied across stages. So that's the part I'm really excited to be sharing with everybody. So thank you so much for coming out again, Howard, on a very busy announcement day. Glad to grab you. Michelle, thanks for joining. I'm glad we were able to connect a couple of Khosla fans as well, and ultimately, customers. And now Howard and I think Michelle owes Howard a customer call or a sales call. So it's good. I'm glad.
Just a PO. We'll skip the call. Let's just go straight.
Yeah, exactly. You guys have gotten to know each other a little bit. You understand.
Thanks, Adam.
Awesome. Thank you so much, everybody. Talk soon.